So it looks like we've got a few people still dialing in right now. So we'll go ahead and just get started as people are dialing in. First, we just want to say thank you all for joining us today and taking some time out of your day to hear about RIA merger and acquisition activity that we're seeing right now. As you know from the title of the webinar itself, the idea here was to really focus in on the southeastern U.S. and some of the activity that we are seeing here. So just as a starting point, I'm John Eubanks, Vice President with Park Sutton Advisors, and I cover the Southeast for us, so very relevant topic for me personally. It would be joined by Steve Levitt, the founder and managing director of Park Sutton, Annie Ternosky, managing director, and Dan Erickson, also vice president with Park Sutton. So again, thank you all for joining us. We hope that this will be conversational in nature, and we're going to tell you some of the things that we're seeing in the market in general, just some of the things we're seeing with deal structures, terms, how transactions are taking place. But please, throughout the way, feel free to ask any questions through the Q&A function if you have any particular topics you want us to discuss. So again, focus on the Southeast here, and this is an interesting market because from 2017 through 2019, among 15 fastest growing cities in the country, 8 of those were in the South, 6, and then the rest were in the West and Midwest. So a lot of growing areas in the Southeast. You've got Atlanta, Charlotte, Nashville, major market hubs. I think Atlanta is the top 10 economic producer in the country, number 10 in terms of GDP. So obviously a lot of acquirers are very interested in wealth management markets where there's not only population growth, but wealth growth as well. And there are a lot of these markets in the Southeast that fit that profile. The other thing that's interesting about the Southeast in general is that in some of the second tier cities outside of the Charlottes and Atlantas of the world, some of the smaller secondary cities, you see a lot of these markets that are still dominated by wirehouse groups and wirehouse teams. And so there's a significant amount of opportunity for the independent firms to gain market share. So before we really get into the details of what we're seeing and take questions, we wanted to just mention a few things that we've seen here in terms of activity that has taken place. So just in Atlanta alone, there have been a number of transactions this year that have been notable. So Joint Advisors was acquired by a Wealth Enhancement Group earlier this year. That was a $1.4 billion assets under management firm. Hightower recently announced the acquisition of Stearns Financial Group, which had offices in Greensboro, North Carolina, Chapel Hill, $1.5 billion. Welsh Hornsby in Birmingham, Alabama, with $5.5 billion, sold to Cap Trust earlier this year. Willingdon Wealth in Huntersville, which is just outside of Charlotte, sold to Essential. So clearly a lot of activity in these markets, and there will be a number of notable transactions being announced here over the coming months as well. So that's really the backdrop for the marketplace and why we chose to focus this on the Southeast. There's growth, there's a lot of activity occurring, and it's clearly on the top of the list of many of the large acquirers out there. So maybe we'll start, Steve, I'll start with a question for you, just because we get just high-level questions all the time about what are we seeing, what do transactions look like, what are valuations. So maybe if you want to just touch on some of the trends we've seen maybe in the last 18 months versus 3, 4, 5 years ago, how those deal structures are changing and what we've seen in terms of valuations. You're on mute. Hey, Steve, you're on mute. The perils of technology from afar.
The new Zoom world in which we all navigate. But thanks, John, and thanks to all of you for joining our webinar this morning. We really do appreciate it. I'm the founder of Park Sutton. I'll just mention We're in our 13th year. John is based in the state of Georgia, but the rest of us operate out of New York. We are very active working on deals. I would say this year we've already completed 7, even with the pandemic. We're on track to close 12 or 13. I would say that some of what's changed in the last few years, maybe I would go back even a little bit more. 10 years ago, I mean, it was just a super different environment. There wasn't the same level of interest in RIA transactions that we've been seeing the last couple of years. And I mentioned this is Park Sutton's 13th year. I've been working in this sector now for 24 years. I would say that over the last few years, there have been more and more folks who are looking to acquire all different types of wealth managers and firms just in general serving high net worth individuals, and that goes from affluent all the way to the ultra high net worth. And I think that the activity has really been picking up. I believe that we thought January, February, pre-COVID was top of the market. I think our team has been a bit pleasantly surprised to see while March and April deals weren't falling off, but they were taking a little bit longer. But we really have seen this unbelievable burst of interest, and some of our clients have been experiencing bidding wars, in fact, the last couple of months. But one major change, aside from the fact that the activity and interest and continues to pick up, I think that in general, we're seeing the deal structures being even more aggressive than they were a few years ago. And what that means is not only are the multiples higher, and buyers of firms in this sector tend to focus on the EBITDA multiple, but multiples are up a point or two. But it's not just that. Buyers are also paying on pro forma EBITDA, which in many cases includes significant levels of synergy. I would say higher percentages are being paid at closing than in the past. I would also say that the payments are being made faster. So it used to be a seller would receive payments over 3 to 5 years. Now we're looking at something more like 1 to 2 years at 3. So much, much faster. So just a lot of interest, a lot of groups looking to do deals. Some of these are private equity backed. Yeah, I'll stop there.
I might just add to what Steve's comment. I think, in our view, a traditional deal structure historically in this space has been about half to 2/3 of a total valuation paid at close. And we're seeing top offers come in much higher than that now. Could be 70, 80, 90% now. Pre-COVID, we got a few offers that were actually 100% cash at close. And these were significant size deals. These weren't small deals. So they were, call it 25 million valuation plus deal sizes where the entire consideration was offered at close. And I think throughout, perhaps late March, when markets really took a pullback, some of this, I wouldn't say the valuations came down, but some of the structures were a little bit less aggressive, although buyers were still giving, the sophisticated buyers were allowing sellers the opportunity to catch up to where their valuation might have been prior to the market decline. But the structures came back a little bit around that time. Valuations did, and I think coming out of this now, valuations might even be a little bit higher overall than they were, like Steve was saying, pre-COVID.
Although I would just say we are still currently working with one client about a buyer. The transaction is a $50 million transaction. They're paying 100% at closing. So this is not something we were seeing 1, 2, 3 years ago.
So Dan, you had mentioned an article you saw recently related to the return of earnouts in a lot of these deals. And, so clearly in general, some people are thinking that with market volatility that, transaction structures will go back to the, former maybe 50% cash at close and the rest paid in earnouts over time. But I think you had some different thoughts, and all of us probably do. But what are your thoughts on the earnout portion as part of deals today and where that's headed?
Yeah, I don't recall where the comment was made, but I think I saw a couple of groups make comments that, you know, they thought contingent payments were going to become more important again. I think, you know, that might have actually been our view to a certain extent. And this goes back to what I was saying before, where deal structures were changing a little bit and, you know, earnouts were maybe coming a little bit more back into play. I mean, that just, it hasn't been our experience. I mean, I think we thought this might have been a trend that we would see beginning to occur again, but it was very short-lived for a couple of months, and I think we're back to where we sort of were pre-COVID, where it just hasn't been our experience. The offers that we're seeing, largely earnouts are in the form of retention of clients. So just maintaining clients over a year or two will get you most of your total valuation. In certain circumstances, it could even just be a lapse of time. So you're not even needing to retain clients, and you can still receive your next piece of consideration from an acquirer, you know, 6 months or a year after, for essentially nothing.
So I think, yeah, one of the interesting things there, we get a lot of questions from people about, you know, what these transactions look like. One of, I think, the common misconception there is that you've got this idea that if you sell a firm, you know, you lose control day one, everything changes. And you know, life just is completely opposite of what it is when you're in control of the firm. But Annie, you had mentioned some a particular scenario recently that I thought was interesting. So maybe you could speak to that
Sure.
a little bit.
Absolutely. And thank you, everybody. Thank you, John, for the question. And I'll just, you know, segue a little bit from what Dan was saying, just because it's so easy to take these kind of comments that we make as financial people that are in and out of these deals. It's very easy to take these comments out of context and assume that there's kind of a formula for just getting these things done. And the fact is, while yes, all of this is based in numbers, and it's just, there's lots of different levers on the control panel. And if you pull this lever over here, it's going to affect this gauge over here. So these structures, it's very easy for us to kind of speak in these generalities. At the end of the day, every deal is very, very specific, and culture is important. What works where there is a founder who's 70 might not work where there are lots of leadership that are still in their 40s, 50s, even younger. So there's lots of different ways to get these structures in place that can align incentives. And that is absolutely critical, having aligned incentives for both sides so that deals are fair for all parties. There is no such thing as I win, you lose. That might get talked about, but it never actually comes together where the deal truly comes and gets closed. It's just going to fall apart eventually somewhere along the way. Going back to John's specific question as it pertains to a group, there was funny, I was on another Zoom call between buyer and seller the other day, and it's a very nice banking client of ours, and they were talking a little bit about the fact that one of their wealth purchases from almost 15 years ago, they closed this transaction in 2005. And I had only just learned, this is a client I've known now for a couple years now, I had only learned that the founder only just retired a couple of years ago. He was there over a decade, which I just think speaks volumes to getting culture right, getting incentives right, and being in a transaction mindset that is about collaborating and coming together and building, you know, helping the ship move forward together. So I think there is a little bit of a misconception out there, perhaps, when folks are, you know, the entrepreneurs that have founded their business, maybe specifically they've come out of other groups, they founded their own firm, and you know, they've put a lot of sweat equity into that firm, and I totally get that. You know, we're entrepreneurs too, and we're small businesses as well. I think there's a little bit of a misconception that founders might think, okay, the people that are going to find this of interest are expecting me to leave within a very, very short period of time. And then what am I going to do with my time? So if that's the assumption, why would I ever entertain doing something now? That isn't necessarily the case at all. And in fact, I would argue that many of the best deals that I've been a part of and seeing come together have been those that are ones where, you know, founder sticks around and second gen is incented and sees a bigger career path in front of them because they're part of a bigger organization. And there's a more institutionalized compensation program and process and ways to get equity into the hands of second gen and then third gen. So I don't think that assumption right off the bat is really accurate in most cases. Most people tend to like to have founders sticking around.
Yeah, and I think that's you know, all those points are a good segue into, you know, some of the transactions we're seeing today and the way these things are taking place. Because one of the things that I think we've seen an increase in for sure is what we would consider more permanent capital structures. So even situations, you know, where there's a large firm that has maybe an issue with an internal succession, maybe they have, you know, succession in place, but founders need liquidity to exit, or maybe they're looking for capital themselves, you know, to grow through acquisitions. There are a lot more transactions taking place today where acquirers and capital partners are actually taking minority stakes in some large firms, which is different than, you know, 10 years ago, just in terms of the number of deals that are occurring that way. I think the other things that are important to Annie's point, and it sort of fit in with the overall environment today, is that, you know, not only have valuations been elevated compared to history, but transaction structures have been more favorable to sellers. There's a lot of competition for good quality wealth management firms. You know, sometimes geography does come into play in those scenarios, like in the Southeast and in particular. But because of all those things, a lot of sellers have more options to really seek the transactions that they want, that make sense. You know, 5 years ago, 10 years ago, maybe it was limited options. Maybe you have to, you know, you have to do a lot more that you didn't want to do just to get a deal done. Whereas today, the number of acquirers compared to historical times are at all-time highs. The leverage that most sellers have to find the right fit and find the right partner and structure a deal that makes sense for them it is better than it's been in the past. And so I think really the environment itself is probably part of the reason that we're seeing more and more of those owners being able to stay on board longer when they want to, and being able to really accomplish these internal successions. But, you know, that said, with the types of capital partners out there, one of the other things, you know, we get questions about a lot are debt. You know, is debt available to RIAs, and how, you know, what types of firms are out there? So maybe, Steve, you could touch briefly on lending and just what we're seeing as far as capital available to wealth management firms.
Sure. I also feel that I'm compelled to say also, I was on a Zoom call with you yesterday, and I was realizing, I think this is the shortest I've ever seen your hair. But anyway, I think that there are great financing options for RIAs. I think that 5 years ago, options were extremely limited, and then groups like Live Oak Bank came onto the scene with SBA lending. The last few years, Oak Street Funding is very active. There are some other folks. There's a Skyview Capital, which is a platform basically of 30 banks or so. You know, we've advised PPAC Gladstone Bank on acquisitions in the New York tri-state area. They've been interested in lending to RIA. So I think that the options are much stronger and varied than they once were, and I think that there are really good options. And you know, at the end of the day, I think in terms of an RIA, it depends on their size, it depends on their use of proceeds, their goals, what they look to accomplish. I think that there are banks they can borrow from. There are even finance companies who will equity capital options if someone is more thinking they would like to take in a partner. We had advised EP Wealth Advisors in California back in 2017, sold 40% to a PE investor, Wealth Partners Capital Group. We just introduced Kudu Investment Management in New York. They made an investment in Sequoia Financial up in Akron, Ohio. So I think that there are really good financing options. And the Southeast specifically, we've heard from folks that SunTrust is getting involved in some of this financing as well.
So, we've talked a lot about these transactions from the perspective of, people that may be looking for capital or, potentially looking to sell a firm, but we also work with acquirers as well, as Steve mentioned. So Dan, maybe you and I had some conversations about, how acquirers, whether they're first-time acquirers or firms that have maybe made an acquisition in the past but want to get more serious about a real acquisition strategy, how can they really position themselves in this kind of market to be successful against some of the really well-capitalized, really active groups?
I think one of the key things, we hear from groups all the time that they're acquirers. A lot of times we're skeptical about groups, whether they are or not. It's really, really important to develop a differentiated value proposition strategy. I think saying that you have great technology and you'll take the compliance burden off of another firm, it'll allow them to spend more time with their clients. You're maybe vague and we can help with marketing. All groups can do those things. Almost every acquirer can do that for you. What makes you different than the rest? And I think for a lot of groups, they're struggling to grow. Net flows across the industry are I don't know, call it flattish to maybe 3%, on average. Some groups are higher, some groups are lower. If you can really help with marketing, what does that mean? What exactly are you going to do? Do you have an expertise going after corporate executives? What's your methodology for doing that? Are you really good at integrating yourself with different COIs, and what's your method for getting leads from COIs, aside from just saying, hey, let me take you out on the golf course and hopefully you refer some business to me. So I think really honing in on exactly what it is that you're going to do to help groups that you might be acquiring, because I do think not everybody's interested to be acquired by an aggregator or some of the other larger RIAs out there. I think that there is an interest from a lot of groups. I had somebody yesterday tell me that they really thought that somebody local would be a better fit for their team and for what they're doing. So I think there is a place for smaller groups to get deals done, but you're going to have to come up with a unique value proposition. A lot of times we've actually seen people who are in study groups, they'll end up perhaps merging with other people that they see eye to eye with, they're in study groups with, and then those groups are now more of scale. They look more attractive as an acquirer. We're having, Steve and I are having a conversation with a group right now about perhaps helping two groups merge together. It'll make them a $2 billion firm instead of a $1 billion firm. And I think if I'm, John Doe seller, I like a local player, I think it becomes more attractive for me to look at somebody who's a little bit more of scale. So there's ways to do it, but it's difficult when you're competing with the deeper pockets of some of the larger groups out there.
So Dan, that's a good point on those sort of, we'll call it mergers of equals. It seems to be that those conversations are really occurring more and more possibly as a result of the market volatility. As firms look around for ways to scale, ways to save costs and be more efficient, two firms coming together and merging can really make a lot of sense when you have synergies and shared opportunities that come into play. So I know that's one thing that we've had a number of conversations about lately, but maybe we could also just briefly each give some general observations we've seen even just in the last month or two. So maybe Steve, you could start with any thoughts that you think are relevant in very recent deals.
Sure. I think I'll just comment to our audience that I think one reason why our Park Sudden team, like others, is doing these webinars more frequently to folks around the United States is this year, it is an unusual time. I don't know if it's due to the pandemic, in spite of the pandemic, but we really do have, I think, a lot of real-time insights as to what's going on M&A-wise in our sector from month to month, much more so than, say, if we were having conversations on M&A in the space 3 years ago. There really is a lot going on, just given the changes in the world around us. Two things I would think that stand out to me from the last several weeks that just come to mind. One is we are working on a transaction in Long Island, New York, which is a suburb of New York City. The deal is closing and being announced, I believe, on Tuesday or Wednesday. And very interestingly, a lot of sellers get nervous about going for the client consents. When you transfer an RIA to new ownership, SEC requires client consent, and you can either go the negative or positive route. If anyone has questions, just reach out to any of us, we can discuss. But I would say that in the case of this particular client, a lot of sellers get very nervous about going through that stage. And here they've actually had to go out to all of their clients, get positive consent. I think they've actually gotten the consents in under 3 weeks for 97% of the revenue. So that's something that stands out as interesting. The one other point I think I would make is I think that as we move closer to the election this year, we have been finding that more and more of our sell-side clients seem to be cracking the whip. There's uncertainty, just in general, but just in terms of what tax rates might look like going into next year. And so we're absolutely finding that more of them are razor focused on closing their deals this year. So I think we've been having a lot more conversation about the possibility of cap gains rates going up, and really, our clients asking us what can they do to accelerate their deals closing.
So maybe that's Steve, I think you covered a number of things there in terms of recent interesting points. Annie or Dan, do either of you have anything that you would add to that?
Sure, I'll pick that up.
I'll just say I talked a lot to give you some time to come up with something. But anyway.
Oh, that was it. Thank you. So yeah, I would pick that up. There's a couple of things I would say that are recurring themes that we see all the time. So this is not going to be anything new, what I just said, but it's interesting how it takes on a different twist depending on how the deal flow goes. And I am a big believer at the end of the day in demographics and whether underlying demographics are supporting what's going on in a particular sector. This all goes back, what John was saying at the beginning of this call. The underlying growth in a particular key geography has so much influence over demand in that area. We see this in different places, the Southeast, Texas, certain parts of the Midwest. These are just kind of key geographies that frankly, this isn't new, like I was saying before, but it's interesting how certain key geographies just kind of pop up and float. And thankfully, we are lucky enough in our business, we cover the whole country, which seems which is kind of no small feat given how the size of our firm, but we do take a lot of pride in knowing lots of different key pockets all over the country. And there is a bit of very granular information that we can glean along the way because we are very, very active. We've got a lot of deals going on in lots of different cities. Groups, sellers benefit from that kind of inside knowledge in any particular key geography. The other thing I'll just mention too is key attributes that that people are looking for. Whether it's certain capabilities that are perhaps more obvious than others, whether a firm is financial planning led versus investment management, that's kind of a simple way to look at it. But other key capabilities that they might have, tax capabilities, trust and estate work, that sort of thing. Those things are really, whether they're in the custodial referral programs, how they treat the custodial referral programs. It's not just enough that you're in it. How do you support it? How do you get enough out of it? Because nothing just kind of magically comes to you, right? So those sort of key attributes, I would say. The other thing I'll notice is capabilities wise, I know Dan mentioned earlier, being able for a buyer to be able to articulate the support they might be able to bring, for example, in a place like marketing. When a seller has figured out perhaps a new mousetrap, that's something that absolutely resonates with people. Wow, I hadn't really thought of doing that. If they've figured out certain kind of branding and they've really kind of done it well, even on the shoestring budget that many of these smaller firms can have put together. When people are a little bit more thoughtful and have really kind of put years worth of that effort in, it really does kind of show and increases further opportunities for them as they're seeking these sorts of partnerships. Dan, would you add anything to that?
I'll leave it at that.
Oh, Steve and I took all the air out of the room.
So. I don't even remember the question at this point.
Right.
Well, that is, one of the things that Steve mentioned earlier on the topic of this discussion was tax rates, and what we're seeing with people accelerating transactions, which is an interesting discussion in itself because, of course, we have no idea what's going to happen this year, next year. But maybe, Dan, you could speak a little bit to the timeline that it typically takes to get a deal done. And what is realistic versus, not, and what's typically normal when somebody starts the process of trying to find the right strategic partner.
Yeah, so in general, between gathering due diligence information from groups, I mean, we'll reach out to, it could be just a couple of potential acquirers on behalf of the seller. It could be more than that. We're gathering due diligence information, and then we're putting together a confidential information memorandum for potential partners to review to see if it's an opportunity that they're interested in. So between, gathering that information, putting the book together, reaching out to groups, coordinating meetings between groups, meetings actually occurring, and then, generally we'll receive 2 rounds of proposals from these groups. It can take 6 months on the very short end, up to 12 months. I would say it would be extremely rare for the full process to be less than 6 months. Occasionally it could be beyond 12 months for who knows, maybe we have a COVID-19 that makes a deal take a little bit longer. But in general, 6 to 12 months, probably more like 9 to 12 months. So it's one of those things where if you think you want to be, well, also consider if the acquirer is going to want you to be around at least for a few years post deal, if you're looking to be completely exited from the business, over the next several years, I mean, you really need to start a process now, because it's going to take you 9 or 12 months to get to a deal closing, and then maybe you're on board as part of the new firm for another 2 to 3 years. Could be more, could be less. So if it's something you're really thinking about, now is the time to be doing that.
I would just add one quick point that we have certain clients too who will come to us who it's not that they even want to sell right now, but maybe they know they want to in 2 or 3 years, and they want to be as well positioned as possible and really understand how they're going to be evaluated, and not try to just pretty themselves up very quickly, but really do what they can over several years. So we work with folks on that.
So Dan, I think an interesting thing there you mentioned is just talking about that process and what, really you have to go through to get a firm ready for a transaction and what that process looks like in terms of reaching out to potential acquirers. So I think one important thing to note is really what that consists of. I think a lot of people in our industry, there are industry consultants, there are business brokers, there are investment bankers. Everybody approaches those transactions a little differently. And so there's a big difference between, the first part of that stage, which is maybe just finding the right fit. And what that looks like and how many people do you really talk to find the right partner. So these processes are very structured, which is why it takes time. And that's really the only way that you can find the right strategic partner in the right environment that gives you, the right opportunity to select really who's going to be the best fit for you and your firm, your employees, and your clients going forward. So Steve, maybe you could just briefly touch on some of the areas there related to that process or in general that are important for people to understand.
For people to understand in terms of selecting a banker or moving forward on their company?
Yeah, I would say both. I mean, particularly in terms of selecting a banker. I mean, when does it make sense to work with someone like a Park Sutton versus, just a general industry consultant, which of course can provide advice as well.
Yeah, I mean, this is an extensive topic, and I would say, I mean, since the beginning of my career, and having launched this business in April of 2008, I've been aware of the fact that a lot of firms don't hire advisors or investment bankers. I think they figure they can get the necessary counsel from lawyers, or sometimes there are introducing agents who are really more finders who might connect you with some folks. But I think that several things I might comment, and then maybe if Annie or you or Dan have other comments, is look, I think that when you're considering a transaction, for many folks, I mean, we're not talking about Amazon buying a company for billions of dollars. For most of our clients, these are entrepreneur family businesses, privately owned. Most companies will have values of 10 to 200 million. I would say that for your families, this is really important. It's a once in a lifetime event. Much as the same, I would imagine, as it is for your clients when they're selling all different kinds of businesses. You're doing this once. You need to do it right. It's figuring out who is the right partner. I mean, this is a marriage. How do you present yourself? What are fair terms? I mean, fair is obviously in the eyes of the buyer. I mean, what one thinks is fair, it's incredibly amorphous what is fair. And so I think it can be important to have the market speak. You need some competition, whatever that means. I'd say for some people to decide and figure out the right path, they might need to talk to 20 people. Other people, it might just be 3 people. I just think that it's my own personal view. If it were me selling Park Sutton or someone's family selling their business, you don't talk to just one folk in general. And then I would say it's hard. It's for the terms. It's hard to negotiate for yourself with that future boss. And I would say in general, this is a very emotional process, and it's just helpful to have a sounding board every step of the way. And I know that we sometimes talk with folks. Annie and I are aware of a firm in New Jersey that did not use an advisor, and we represented a client with very similar statistics, and I can't remember the magnitude of difference, many millions of dollars different what our client received versus that one. But anyway, I don't know if any of you have other comments on how someone selects someone, or things to think about given how important it is.
I'll pick up that thread. So, and I'll just punctuate with a piece of data. Steve mentioned this one particular transaction, and it's hard to go back and say, gee, why'd you do that? But just to give an overall piece of data, in some of our processes where we'll go out to a sample size of groups, there can sometimes be 300% difference between the low bid and the high bid. So, and I hate to use the word bid just because it sounds so off-putting, but generally when we see a process, there's usually a standard distribution, a bell curve. 90% of the folks are kind of in the middle, 5% is the low, and then hopefully we get 5% or more at the higher end. But the swing between this low one at $1 versus the high one at $3 for the whole firm, it's confounding to me when they've all been given the same information, the same access to the seller. It's just shocking to me. So that, as Steve is mentioning, okay, it's kind of useful to put an array in front of you so that you can some people can't figure out what they want until they see what they don't want. And that's a useful process, and it can help you just in making the decision. If you're only talking to one party or just, two parties, I don't view that as the sample size. Here's an interesting point. I was on the phone with another group, a group, frankly, that's looking at perhaps one of the groups we have for sale right now. And he mentioned, I know he's not necessarily happy about the fact that he's having to participate in a process. He'd rather just get the deal done with the seller. He's not coming out and saying that, but I know that's the case. And he's saying, I'm looking at 30 other groups, at which point I just said, oh, okay. Would I ever ask them to stop talking to all the other 30 people that they're talking to? Just like they're asking us to only talk to our seller. That's just doesn't make any sense. Everybody talks to everybody, and this is just the way it works, so that you can find the partnership that actually works for both sides. Picking up from where we go from there, it's hard in evaluating an advisor. I would say, please do your homework. And I'll say this too, for lawyers too, or accountants, just like any other vendor you would choose, please, get references, talk to other people who have worked with these firms. This is helpful. And even if it's just useful information so that you can feel better about the decision you're coming to. The other key thing I would just say is access to information is critical in a role like ours. 99% of the deals that get done in our sector are private transactions. The information is not made public. So unless your advisor is in the mix and knowing what's going on in this deal flow, it's very hard to understand exactly where things are moving. And the way for somebody who is looking outside in and making an evaluation, the easy way to capture, okay, is this person active or not, is to ask for their deal list. Just ask for what transactions have you worked on this year? What was last year? What was the year before? And then that'll at least give you a little bit of a sense of what actually got completed. That to me is, and what actually closed, because a lot of people are out there saying, okay, I'll introduce you to these couple of parties. The problem is a lot of those things don't actually get closed, and then you may have been spending a whole lot of time on something and not actually getting to a deal at the end of the year, which can be frustrating and exhausting. Dan, would you add?
I'll just make one last comment. I know we're getting close on time, but I think our experience is that, and we speak with a lot of different groups, people who don't have an advisor, I think at worst, at best they're getting a deal that's not market. At worst, for a lack of better way of putting it, they're getting totally screwed. So I mean, maybe you're looking at the four of us and saying, I just don't gel with this group here, but hire somebody, get help from some sort of advisor, because I think that's probably better than nothing. And I'll give you another example. I mean, and this came up from a comment that Annie just made yesterday. I mean, we know of a group who, this doesn't have to necessarily do with economics, but this group is being sold by a potential acquirer that, they're going to help them get deals done. I mean, this firm has, I think, maybe 450 million in assets, and they're being sold by this acquirer. We're going to help you get deals done. We're going to give you deal flow, this and that. And then I think Annie was talking to the other day, randomly, another group that's partnered with this acquirer, and they said, yeah, that's what they told us too, and we haven't seen one target. So, I mean, if you don't have some sort of advisor, I mean, how would you even have that piece of information? So it's not just the economics, it's these other things. I mean, we're agnostic at the end of the day who our clients go with, but we can at least help to give you information that will be useful in your making the right decision. So again, I mean, you might not like Park Sutton, but it's good to have help from somebody.
And I would also, just related to all of this, again, for those of you who might at some point do a deal, particularly with one of these very experienced acquirers, there is such an incredible information imbalance. I mean, these are, again, I'm being blunt, I'm a New Yorker. These are smooth talking people. They've done a lot of deals. They know how to court the other side. A lot of them are going to encourage you. You don't need to hire an advisor. And it really, particularly in an environment like what we're seeing in the last year, I mean, normally before we get hired, we're going to be very conservative in terms of when you ask us, well, what is your business worth? We're going to be conservative because we would rather outperform. We don't want to have an unhappy client. We manage expectations. I mean, we're just seeing offers. We're currently working with someone. I think we thought that they would get 17 million. They're getting about 30 million. I mean, these are not normal times, and none of those buyers are gladly paying that 30 million. They're doing so because they have to in this competitive dynamic, or they're going to lose it. And so, we just get information, talk to different people. We just encourage you. I think Dan made an excellent point. Whether it's us or someone else, just get good advice.
So I know we are running up on time here, and we certainly want to be respectful of everyone's time and appreciate you joining us. So maybe we'll just wrap briefly with the reason we started to begin with this particular panel discussion, which is really the Southeast. So to Steve's point, that the firm that he mentioned previously that's receiving a much higher valuation than expected is in the Southeast. And we're seeing buyers interested in the Southeastern market for all the reasons we discussed. So right now it is very active. But on the other side, I would say there's still opportunities for those large firms that are located in the Southeast that want to be the acquirers themselves in some cases. So that can go, both ways. So maybe we'll just wrap briefly. I know one of the things people have questions about is, well, what's happened so far? What are you seeing in the environment? But then secondarily, where are we going from here? So maybe, Steve, you could just provide a couple of comments with regard to, what we see potentially happening over the rest of this year and maybe into the first quarter of next year, and we'll end it with that.
I think our team, just to keep it brief, I think we have a common view that, yes, the market is at a new high. Yes, there's uncertainty around what may happen. I think many believe there could be a correction. Some continue to be bullish. It's all uncertain. I think what we do think, though, is there still is tremendous M&A momentum. There is still a very significant imbalance of buyers and sellers, way more buyers than sellers. I do believe that we think M&A activity going into next year will continue to be quite strong in this sector.
Thank you. And thank you all for joining us. We certainly appreciate you taking the time. Of course, any one of us on the call are happy to answer questions at any time if you're considering, a transaction or just thinking through what your options are and want to know, what we're seeing out there in the current environment. We're always happy to talk. So please feel free to reach out anytime. And again, we appreciate it and hope that everybody enjoys the rest of your day and the rest of the weekend. Thank you.
Thank you very much.
Thank you all.